Good morning. This is Stephen Paletti with Paletti Real Estate, brokered by eXp. And as my guest this morning, we have Jeff McMullen with Cross Country Mortgage. And we're going to talk about the various buy down programs that are available. And I think you'll find this very informative, and it really does open some opportunities up for buyers that you may not realize. So, Jeff, can you take it away and give us a lowdown?
What we're going to be looking at today, I'm going to share my screen. We're just looking at $1 million transaction. So today, if you were buying a house today, it's $1 million home. That's a rate of 6.75. Be a monthly payment of $6,330.45. That's an all-in payment. So that's taxes, insurance, principal, and interest. And this is a 30-year fixed mortgage market right now. We're seeing some weakness, and so a lot of times people are going in and they're offering less. We want to show you the difference between price reduction or what we like to call a seller buy down, which is basically using funds from the seller to buy your rate down and get and to pay points. And so we'll start in this price versus rate section here. So that would be, instead of offering $1 million, you offer $912,000, assuming that you get the same rate on the loan, which would be the case. You're putting down $192,000, and your monthly payment goes to $5,873. So that's fine as long as you can get the seller to take $87,000 less. That's the hard part, right? Is somebody's buying a house and you're saying they're thinking they're getting $1 million, but you want to offer almost $90,000 less. Sometimes that offends people. Sometimes that doesn't work out. So what we've seen is that the most important thing from a payment standpoint is the rate. And so the second thing we're going to look at is this rate reduction option. And so still offering $1 million on this, and your loan amount would be the same as it would in the original one, but you're going to get a lower rate. The way you're going to get that lower rate is the seller is going to give you a credit. That's a credit for $25,840. And so what that does is it makes your rate, instead of being a rate of 6.75, it takes your rate down to 5.875. And as you can see, that monthly payment, $5,873.97, is the equivalent of a $912,000 purchase price with a $729,000 loan. So what we found is this is a good way to split the difference, right? It's a good way it's a win-win for both sides. So it's the buyer saying, I want my payment to be better because I don't want to pay that much for the house. And it's the seller saying, I'd rather give you a credit for $25,000 than reduce my price by $87,000. So what we found when we've used this technique in this negotiation, it just seems to be a way that the clients can come together when they're essentially $90,000 apart. They get to $25,000 apart, and that seems like a way to win in these scenarios.
Great. Well, it seems then that you're making up the difference of almost $75,000, right? Because the original offer price was $1 million, but the actual price with this buy down is $975,000, correct? Because the difference to the seller is only $25,000 net less.
Correct. Yeah. And so the assumption that we're making in this scenario is that there is some weakness in the market, right? So this is a house, and this would be something where your clients would need to rely on you, Steve, to know if there is weakness, right? Like, is there some wiggle room here? Has the house been on the market maybe for a long time? Is it just overpriced, right? Are the sellers just being a little bit more optimistic than is real? And then what can we do with that negotiation? And so this is one way that this is kind of another tool that you guys can put in your bag of how we're going to negotiate.
Terrific. Now there's also a 3-2-1.
Yeah.
Yeah. Can you talk a little bit about that?
I sure can. So this is a little different. The way a 3-2-1 buy down works is you're getting a loan you're still getting a 30-year fixed loan. All right. So you're still getting a rate of 6.25 on a 30-year fixed loan. This was done a few days ago, so the rates are a little bit different. That said, the principle is the same. So a 3-2-1 buy down is the first year, the rate is 3% lower. So you can see that 6.25. The first year it's 3.25. The second year, it's a rate of 4.25, which is 2% lower than the actual rate of the loan. And then the third year, the rate is 5.25, which is 1% lower than the loan. That's why they call it a 3-2-1. So it's 3%, 2%, 1%. This buy down is paid for with a seller credit. And that is paid for basically out of their out of their concession. So this is strategically, this is a buy down that you would take if you thought you were going to refinance or pay off the loan in the next 3 years, right? We, the mortgage industry in general, does believe that, or we do believe that rates will be coming down in the next 6 to 12 months. And so getting a rate at 6.25 right now, but having the temporary buy down for the next couple of years gives you ample time to wait for and then refinance. There are some risks to that. Obviously, if you, for some reason, couldn't refinance, if you lost a job, if you suddenly had bad credit, if you had a big, if you filed for bankruptcy and you just were unable to do the loan, then you wouldn't be able to refinance out of it. But assuming that that doesn't happen, assuming that the job that you had when you bought the house is still good and that you still have good credit, you can refinance out of that when rates go down. And so this would be a way to just get you into the house, keep your payments affordable until you could refinance to get a lower payment.
Got it. Got it. Now, I know that you had mentioned in a presentation that I'd seen earlier about the different percentages that might be available through these buy downs, up to even 9%, as I recall. Can you talk a little bit about that kind of?
Yeah. So every loan has they have a different availability as far as what you can get as a credit. Every different loan type has a different amount of concessions that they will allow. So for conventional loans, so if conventional loan is a loan sold by Fannie Mae or Freddie Mac, this is the most common type of loan that we're going to see. This is the loan that most people have on their homes. If you're putting down less than 10%, the maximum credit that the seller can get is 3% of the purchase price. If you're putting down 75 to 90%, or between 25% and 10% down, it's a 6% credit. So that's 6% that the seller can give you. And if you're putting down 75% or I'm sorry, if you're getting a loan for 75% or more, so you're putting 25% down, then it's a 9% credit. Now it's different if it is on an investment property. So the investment property, you can see there that it's actually only 2%, and it doesn't matter how much you're putting down. 2% is the only amount that you're going to get.
Got it. Yeah.
And then there are different types of loans. So there's FHA loans. These are typically first-time homebuyer loans where you're putting down 3.5%. You can get a 6% credit. And that's because it's a government-backed loan that's designed to help first-time homebuyers. And so they're trying to allow you to get as much concession as possible.
Sure.
And then for a VA loan, which is only available to veterans who've served in the military, that is a 4% credit. And that's and that doesn't matter on loan amount. And so this is something where usually, Steve, you and I would have a conversation before we're making the offer, and it typically is you calling saying, hey, hey Jeff, what's the most we can get out of this? And then you negotiate based on knowing that I can get as much as 4% or I can get as much as 3%, and I'm going to ask for that and see what the seller gives us, right? And then from there, we can use that money to buy down the rate by doing either one of the two scenarios we talked about. We could do a 3-2-1 buy down. There's another one that's a 2-1 buy down. You can do a 1-1 buy down. And remember that the numbers always denote the drop in rate per year. So there's literally a buy down you can do for 1 year. There's a buy down that's a 2-year product, and there's a buy down that's a 3-year product. Or we could do the permanent buy down, which just never goes away, and you buy the rate for the rest of the life of the loan.
Got it. Okay. Well, terrific. So if you will, tell people how to get in touch with you.